Welcome to this video on how to find great stocks. We will explore 6 essential steps for identifying quality investments. Step 1 is to screen the market to eliminate weakness. Focus on criteria like profitable companies, reasonable price to free cash flow, and positive earnings per share and sales growth over the past 5 years. This initial filter acts as your first line of defense, ensuring that you only allocate capital to businesses with a proven track record of operational excellence. By demanding profitability and strong cash flow relative to price, you effectively remove speculative traps and overvalued laggards from your field of vision. Furthermore, requiring consistent growth in both sales and earnings over a 5-year period demonstrates that a company has the resilience to thrive across varying market conditions. Sticking to these strict parameters allows you to ignore the noise of the broader market and focus exclusively on the high-quality, institutional-grade opportunities that offer a legitimate foundation for long-term value. Step 2 involves sorting the candidates by market criteria. A good starting point is to sort by price to earnings, from lowest to highest. This sorting process allows you to identify which high-quality companies are currently trading at the most attractive valuations relative to their peers. While the screening process ensured the business is fundamentally sound, the sort helps you pinpoint where the greatest potential for a margin of safety exists. By organizing the list from the lowest to the highest PE, you are effectively prioritizing value, looking for those instances where the market may be temporarily discounting a company's earning power. This disciplined approach ensures that you aren't just buying a great business, but you are buying it at a price that justifies the investment and aligns with the principles of institutional money flow. This chart illustrates market segmentation by PE ratio, helping you determine if a stock falls into a value trap, a core value investing universe, or a growth target. By visualizing the spectrum of valuation, you can quickly categorize where a company sits in the eyes of the broader market and whether that positioning aligns with your specific investment goals. At the far left of the scale, we encounter the first segment labeled as potential value traps. These are stocks with the lowest PE ratios that are often described as being cheap for a reason. While a low multiple is generally attractive to a value investor, this zone serves as a warning. It represents companies where the market may be pricing in fundamental decay, permanent loss of market share, or structural failures. In this category, the low price isn't an opportunity, it is a signal of distress, and without the strict quality filters we established in Step 1, these stocks can lead to significant capital erosion. Moving into the second and third segments, we enter the core value investing universe. This is the value basket where high-quality companies meet attractive valuations. When a stock that has already passed our tests for profitability and growth lands in this zone, it represents the ideal intersection of price and quality. The market is offering these businesses at a discount, but unlike the value traps, the underlying fundamentals remain intact. This is the primary hunting ground for generating a significant margin of safety, as you are acquiring institutional-grade assets before the wider market recognizes their true intrinsic value. As the PE ratio increases into the fourth and fifth segments, we transition into growth and momentum targets. This growth basket consists of companies with strong earnings potential, where the market is willing to pay a premium for future performance. While these companies are often top performers, the margin of safety begins to thin as expectations rise. Finally, the scale ends at segment 6, with a high valuation warning. These stocks are characterized by the highest PE ratios and are often considered too expensive. In this red zone, the potential for overvaluation risks is high, as the price has likely outrun the current earnings reality, leaving little room for error if the company's growth eventually slows. Step 3 is to choose your top candidates. Based on your screening and sorting, select the stocks with the highest potential. This is the stage where you transition from broad quantitative data to focused qualitative selection. By looking at the core value universe identified in your segmentation, you can isolate the companies that offer the most compelling combination of fundamental strength and attractive pricing. You aren't just looking for any profitable stock, you are looking for the leaders that have successfully navigated the filters of profitability, cash flow, and sustained growth. Selecting these top-tier candidates ensures that your capital is concentrated in the highest probability setups. When you align your selection with these market criteria, you are positioning yourself alongside institutional money flow, focusing on companies that major fund managers want to own. This disciplined selection process reduces emotional bias and forces you to stick to the mathematical reality of the data. By the time you reach this step, your list should represent the absolute best opportunities the market has to offer, providing a rock-solid foundation for a long-term investment strategy built on a legitimate margin of safety. Step 4 is to analyze the fundamentals of your chosen candidates. This involves a deeper look into the company's financial health and stability. You are moving beyond the surface-level metrics to ensure the business possesses the structural integrity to support long-term growth. This deep dive requires examining the balance sheet for manageable debt levels and looking at consistent return on equity to verify that management is effectively deploying capital. The goal here is to confirm that the company's investment-grade status is backed by durable competitive advantages and a robust financial foundation. By verifying these internal mechanics, you protect yourself from hidden liabilities and ensure the margin of safety you identified in previous steps is truly anchored in reality. This level of scrutiny allows you to invest with conviction, knowing the business is built to withstand periods of market underperformance. Step 5 is to learn as much as you can about the quality names you've selected. Thorough research is key to making informed investment decisions. This is the stage where you move beyond the numbers and begin to understand the narrative and the moat surrounding the business. You must investigate the industry landscape, the strength of the management team, and the company's specific competitive advantages that will allow it to maintain its market position over time. By immersing yourself in annual reports, investor presentations, and industry trends, you gain the conviction necessary to hold through inevitable market volatility. This depth of research ensures that you aren't just following a ticker symbol, but that you truly understand the engine driving the value. When you combine this qualitative insight with the quantitative filters from the previous steps, you transition from a participant in the market to a disciplined investor who understands exactly what they own and why they own it. Finally, step 6 is to check for a margin of safety. This is your final test to protect your money before you buy. You must make sure the price of the stock is much lower than the actual worth of the company. If a margin of safety exists, it is safe to invest and live with the results. Long-term holding with a margin of safety is the cornerstone of value investing. By making sure there is a wide gap between the current price and the real worth, you protect yourself if things go wrong. It's important to understand that even the best companies go through periods of underperformance. Having that cushion helps you survive those drops, so you only buy when the odds are in your favor. If it is your goal to outperform the market, you must understand institutional money flow. Major investment fund and money managers tend to want to own the top performers at the end of each performance period. If it is your goal to align with institutional capital, you would be better off owning stocks that are performing either in line with the market or outperforming the market, but only after this final safety check gives you the green light.